All right, well, welcome everyone. We're doing another one of our webinars here where James, Kenny, and I are going to dig in a little bit deeper on some of the factors that are affecting cattle markets right now. I'm Josh Maples from Mississippi State University. With me, I've got James Mitchell at University of Arkansas, and Kenny Burdine at University of Kentucky. So we're just gonna jump right in and split things up and talk about some big things in the cattle markets right now. So I'm going to kick us off today talking about drought conditions, and then I'm going to kick it to James, and he's going to talk about some more things on the feed stuff side, and then Kenny's going to kind of wrap up for us at the end. But drought conditions are a big factor that's overhanging this market right now. So this is the drought map that just came out this week. So we're looking at quite a big deal in terms of what's going on to the west of us. Not a whole lot of drought concerns here in the southeast, right? We've had a lot of moisture, had plenty of rain, but if you go just west of us, and that's not the case. So I wanted to start us out showing us a comparison. So guys, this is a map from this week a year ago, which we were worried about some other things a year ago, but still, drought wasn't really on the radar that much just a year ago. But compare this to the current map. And so you can see in 12 months time, we've really seen the drought conditions expand. And this is leading to some really poor pasture conditions in a lot of these areas, especially the areas here where you're seeing the dark red colors. Not just poor pasture conditions, it's affecting how much hay's had to be used. And also, we're to the point where it is causing very likely causing beef cow herd liquidation. So this is the U.S. range and pasture conditions. And so this starts being released in May each year. And you'll see these last couple of weeks, we've been sharply higher than we were a year ago, sharply higher than the 5-year average. Actually, this 44-45% is the highest total for poor or very poor pastures on record. And the records go back to 1995. So over the past 25 years, this is the worst that it's been for those weeks. So overall, really poor conditions, pasture conditions. Again, that's not the case here in the southeast. We've been relatively fortunate in terms of what our pasture conditions are. Really similar to a year ago in terms of how much of our pastures are poor or very poor, less than 10% in the southeast region. I just want to kind of wrap us up with some implications of this, because this is an important thing for our market, an important thing that's affecting prices. We haven't had the issues here in the southeast really, but drought conditions are historically poor for the U.S. as a whole. And this is affecting where cattle can go and what the forage conditions look like for those cattle in other areas. Beginning hay stocks were released recently, especially for those heavy drought areas, starting out the hay year with lower stocks than we had a year ago. So used up more hay than usual. And James will talk about a little bit more, but feed costs are higher. So we've got a situation in a lot of areas where drought's causing poor pasture conditions, don't have as much hay on hand, and also looking at higher feed costs. All these things are combining to lead to some beef cow herd liquidation in some areas, and without some relief in some of these areas, it appears that we're going to continue to see more of that. So I'll stop there for now, and I'm going to kick it over to James to keep the discussion going.
I'm going to cover corn markets and kind of talk the impacts, right? So, the other big kind of point of discussion we've been really looking at closely this year has been feed costs. And really all that means is we're talking about corn and what corn's currently doing. So this is the Omaha corn price. This is, one of many series that you could be tracking. Most recent week of data we've got has corn at $7 a bushel. Nationally, the most recent WASDE report that came out last week has us finishing out the year at $5.70. So definitely expensive corn, and really feed costs in general will follow the same types of trends that the corn markets are showing us. And so the question then really is, okay, well, how do we get to $5.70 corn, right? So here we've got planted acreage, and so it's not really a supply story per se, right? So acreage is up. I think when we came into the March planting intentions report, we were probably expecting to see acreage for corn up even higher. And so I think our markets definitely reacted to that news, but we've got higher planted acreage in 2021. The crop progress report has us at 80% of that crop is planted. We're slightly ahead of where we were in 2020. Emergence is about 40%, but when you look at that number, that's very variable across different states, right? So Josh showed us that drought map. So for example, you look in North Dakota, emergence is only at 8%. So weather concerns, we're more concerned about things like soil moisture, drought, at least at the onset, isn't a huge issue. But I mean, weather, if we don't have a great growing season, that can certainly change the supply side story for us. But year to year, crop, once we plant it, once we harvest it, the supply side's fixed. And so it's really a demand side story that's really been driving this market as of right now. And so what we're seeing is, if we really need to go back to 2020 to talk about, the demand story. So exports, I think, were probably the thing that have been really driving this. So exports were up 52%, I think. And so going into next year, the next crop year, so the 2021-2022 crop year, with exports being so high, with after COVID, the ethanol industry certainly tried to recover with higher gasoline demand. So those two factors, really high exports, China, right, trying to rebuild their pig herd after African swine fever, and then our economy recovering with higher gasoline demand. Those things are really getting us to a really tight stock situation. So when we go into this new crop year, stocks are going to be tight. And so, if the demand side tells us that it's going to be tight, then we really need to monitor what supply for this new crop is going to do. And so the question for that is, in this June report that's going to come out, are we going to see a revision to planted acreage? I don't know. That's probably pretty hard to predict, but that's certainly the next thing to kind of be on our radar as we finish out this current crop year and really start looking at how the growing season's doing for us as we go into 2021, 2022. In terms of what that means for us and for our cattle producers, there's really two big impacts we can talk about, right? So cow costs, and then feedlot cost of gain, and the value of feeder cattle because of that. So cow costs, here we've got our cost of running a cow, so dollars per cow. These are our cash costs. This is not going to include things like depreciation on our machines and buildings. But 2021, it has us at $829 to run a cow. So about $9-10 above where we were 2020, right? So we're going to have a higher feed bill because of higher corn prices. That certainly has implications for us. But the really big one is going to be what's happening for our feedlots in terms of cost of gain, right? So a few weeks ago in one of our newsletters, Kenny, I think, summarized this as good as you could, right? He said feeder cattle markets are driven by the future expected value of fed cattle, and then the costs of getting those cattle to the processing plant, right? So those feed costs. This is data from some Kansas closeout data for feedlots in Kansas. It's from a monthly newsletter from Kansas State. Y-axis is our cost of gain, dollars per hundredweight. Y-axis is that Omaha corn price, right? And so you see a very strong relationship between corn prices and that cost of gain. So this trend line tells us that if we increase corn costs by $1 per bushel, we're increasing our feedlot cost of gain by $8.32 a hundredweight, right? So that has really big impacts for our feedlots. That's going to in turn impact what they're willing to pay for feeder cattle to come into their feedlot, right? And so this is a chart that I like. This is from some research by Kevin Duvetter and Ted Schroeder. And ignore the numbers, right? So this is from 2000, but I'm more interested in kind of getting the point across that. So we've got this price weight slide. So that's the adjustment to feeder cattle prices as we increase weight, right? So price weight slides on the vertical axis, weight is on the x-axis. So as you move down that line, that's the price adjustment as we get to heavier animals. When we increase the price of corn from the red line to the black line with the blue dots, you see that line is becoming less steep. And what that means is that feedlots are placing less value on lighter animals relative to our heavier animals, right? So it's cheaper to put more pounds on outside of the feedlot. That's really what this graph is telling us. And that's really what we're seeing currently with our feeder cattle markets. And so when we go into the fall, what this means is if we still have high corn, the thing that's really going to impact our markets is going to be looking at what stalker demand does, right? So if drought continues to persist and planting for wheat, for example, in Oklahoma is not looking great because of drought, well, then that's going to reduce stalker demand as well. And then we're gonna have a worse demand situation if we've got both high corn prices, which is impacting feedlot demand for cattle, and we've got lower demand for stalker animals if drought continues to persist. So if I'm going into the fall, I'm watching what this new crop is going to do, and I'm looking at what drought's doing, and those are the two most important things I think as we go into the fall in terms of what cattle prices are going to do. And so that's kind of the feed cost situation. Again, I can't forecast corn for us. I'm not a grain economist. I follow grain markets to the extent they impact cattle markets, but that's kind of my spin on things. And Kenny's going to finish this out with kind of a big tying everything together for us.
Thanks a bunch. Thanks to both of you. Good discussion of both those factors. And both Josh and James did a really good job, I think, laying out the issues related to weather pattern, drought in particular, and then the implications of feed cost changes. And we're dealing with those across the board, and there's major implications for feeder cattle markets. I'm going to mention one more thing that's a little more, I guess fed cattle related, but we are starting to bump into some processing / capacity issues. There's been some things written about that. Look at the dotted line here, which is 2020. And I want to kind of point you to what happened right before we really started to see the labor issues in plants last year. But I want you to notice that, just remember, we were really pushing a lot of cattle through the system there ahead of that. And notice where we've been. Look at blue line now for 2021. We've been running quite a few cattle, and we're bumping into, I think, some potential capacity issues. And understand that off the bat. There's been some changes, I think, in terms of cattle numbers and some of the implications of the feed costs that James talked about that have kind of got us moving quite a few cattle through, and probably as many as we could run in the short run. Another way to think about capacity is to look at Saturday slaughter. And this is oftentimes maybe the best indicator of what packing plants are doing. And again, notice that blue line compared to last year, and certainly compared to that 5-year average. We're doing a whole lot more Saturday slaughter, which is an indication that we're trying to move quite a few cattle through here and probably bumping up against our potential. I wanted, though, to talk mostly about kind of some reasons for optimism. And, it's easy, I think, to get wrapped up in the negatives. And I wanted to kind of give you some positive thoughts here, too, or some good vibes, as the younger folks would say. But, big picture, beef demand is not the problem. And I think it's important we just take a deep breath and say, the good news here is beef demand is actually pretty strong. It's true in terms of domestic demand. We all expect restaurant demand to pick up throughout 2021, and exports have been strong. So the good news is beef demand is pretty solid right now. I also think these capacity issues are going to get better second half of the year. So remember, because of COVID and what we saw back in the spring and summer of 2020, there's no doubt we pushed some of what would have been, second half, probably fourth quarter harvest 2020 into 2021. So that kind of set us up for first quarter this year. We'll work through that. Remember those revisions that the three of us wrote about to the January cattle inventory report. That 2020 calf crop is down almost 2%, from where it was in 2019. And again, it's that 2020 calf crop that's largely going to be 2021 beef production. So, we should get some help in terms of fewer numbers as we move further into 2021. The other 2 points I want to make are kind of related to what James said, is that expensive feed pulls cattle. And I think that may be the piece that's not getting much attention here, but I think one of the reasons why we are trying to move quite a few cattle through is because, holding everything else constant, when you see the kind of run up we've seen in grain price, the signal that's sent or the incentive is for feedlots to pull the trigger sooner. So we've got a lot of cattle, I think, they're probably ready to come off feed, largely because cost of gain is so much higher right now. So I think that's at play. But then thinking about second half of the year, there's no way that I don't think we could have these kind of feed prices, and even new crop is well over 5. We get into fall of 2021, and not start pulling these weights down. And decreases in weights lead to decrease in beef production, and that tends to be supportive of our overall markets. James did a great job talking about value gain and talking about price slides, and what that really means is there will be, I think, more incentive for us, as feeder cattle producers, to add more weight on our own and move heavier cattle. And that's the good news about this is the higher cost of gain in the feed yards provides more incentive for us to add pounds at the cow calf, stocker, and backgrounding level. And then remember this too, I think we learned this, this is not the first run up we've seen in corn price. We've seen ethanol driven run ups. We've seen drought driven run ups. This is like, James said, more of an export demand driven run up. But I think one thing that we learned is that in terms of the species, the main species that consume a lot of this corn, beef, pork, and chicken, beef probably is the most flexible in the alternatives that it can use. And that tends, I think, to bode well as we think about adjustments down the road if prices stay this elevated for a while. Kind of wrapping up with just a few thoughts here. Anytime we're in a situation like this where prices are a challenge and profitability is being squeezed, it's easy to lose sight of this, but you can only control what you can. So focus on those things you can control. And, oftentimes your best insurance or your best protection against a challenging market is moving the kind of cattle that the market wants. And that can mean a lot of things, but keep your focus on quality and respond to market signals. And that may well mean you need to be moving bigger cattle than you did last year, because that may be what the incentives are. Don't stop doing the little things. It's easy sometimes, I think, in good markets to stop doing the little things because we don't think they pay. And then in weaker markets, we don't do them sometimes because we don't think we get paid for them. But, there's a lot of things that just flat out typically pay year in, year out, right? We think about, castrating bulls and selling steers. We talk about, preconditioning, for example, kind of back on what James talked about. Do the things that work for you. Don't deviate from your marketing plan, based on unexpected market changes like we've seen about the last 4 to 6 weeks. Be smart about cutting cost. This is something I've observed over time, is that, when the markets are frustrating, producers do in fact cut cost. And that's not a bad thing, but the problem is sometimes we aren't smart about cutting costs. And there's some costs where you may actually spend less on a per head basis, but you may see production implications that actually cost you more in the long run. So, be smart about the costs that you cut. Be careful about trying to save money on things like mineral, nutrition, herd health. Those are typically areas where you don't want to cut cost. And oftentimes in down markets, one of the mistakes that we make is we simply cut the wrong costs. We save ourselves dimes and cost ourselves dollars. Finally, you want to think long term, and especially if you're a cow calf operator, your cow herd is a multi-year investment, and don't make rash decisions based on short-term market changes when you've got cow herd investments that are multi-year, 5, 8, 10-year investments. So always think long term about your cow calf operations. And then I think every economist has to say this at the end of a presentation like this, but manage price risk. Josh and I did a program a few weeks ago about livestock risk protection insurance. We've all three done things like that. We've talked about futures and options. Some of you may have the ability to use some forward contracts, but be deliberate about managing price risk in the same way you might manage any other aspect of your cattle operation. Price risk deserves attention and it needs to be managed. Both 2020 and 2021 have taught us that. My contact info, reach out to me anytime if you have questions, kburdine@uky.edu. My phone number is listed, and by all means, feel free to follow me on Twitter @KYCattleEcon. We're going to end just by simply showing you kind of our screenshot here for Cattle Market Notes, weekly newsletter the three of us partner to put out on a rotating basis. Got a QR code right there. If you've got a smartphone, you can sign up right there very quickly. If you want to reach out to one of us, we can get you the link to sign up. But we'd like for you to get this weekly if you would like to get it. Market-related articles, and one thing I always say, because the nature of where we work, they tend to be a little bit more focused on feeder cattle, a little bit more focused kind of on the south and southeast areas. So we would definitely welcome you signing up and being part of our Cattle Market Notes group of recipients. So great to be with you, and we will look forward to talking to you next time.